Everyone says gold never crashes, but it did, hard. Silver, too. Prices didn't just wobble, they cratered. Billions erased in weeks. Fear everywhere. Investors panicked. Has the safe haven died? Headlines screamed betrayal. But somewhere in the noise, a quieter group was smiling. People who'd been waiting for this. The crash wasn't their nightmare. It was their invitation. Because what looked like destruction was actually a cleanup, a controlled burn in the world's oldest financial forest. In early 2024, gold brushed the $2,400 mark. Silver spiked past 30. Every YouTube channel, every analyst, every self-proclaimed oracle promised this was just the beginning. And yet, a few months later, prices tumbled 20, 25, almost 30%. How, people asked, if inflation is high, if currencies are crumbling, shouldn't gold soar? It should have, but it didn't. And this is where the story turns strange. Because gold and silver didn't crash despite the system. They crashed because of it. Let's rewind. When you buy gold, you're not just buying a metal. You're buying trust. Trust that this lump of metal will hold purchasing power when everything else loses it. But over time, the game around that trust got complicated. Most gold trades today aren't physical. They're paper promises, ETFs, futures, derivatives, layers stacked on top of a limited base. You could think of it like a bakery selling cake receipts instead of cakes. When everyone wants receipts, it works fine. But when too many people ask for the real cake, there's not enough to go around. That's the quiet math the pros watch. How much paper gold exists compared to real gold locked in vaults. And in 2024, that ratio got ridiculous. Now add another layer, central banks. Nobody mentions how much power they actually have over the gold cycle. While retail investors were buying small coins, central banks were hoarding tons, literally tons of gold. China, Poland, Singapore, but not to sell at the top, to absorb excess supply, rebalance reserves, and, ironically, to let the weak hands shake out. They wanted a cheaper refuel. If you think that sounds manipulative, it's not a conspiracy, it's strategy. Markets need purges to function. The professionals don't fear drawdowns. They cause them to reset prices closer to reality. That gold crash wasn't chaos. It was calibration. You can almost picture it. Middle-class investors crying betrayal, while central bankers sip espresso, buying the dip they ignited. Irony? Absolutely. But it's not new. Go back to 1980. The Hunt brothers tried to corner silver. The price exploded, then collapsed from $50 to below $11. Newspapers called it a disaster. Banks called it normalization. 40 years later, silver still hasn't officially recovered to that level. But the system did. Sometimes the price isn't the message, the mechanism is. So let's dissect what the 2024-25 crash really meant. When gold and silver tanked, liquidity shifted. The world's monetary plumbing unclogged. Investors bailed out of metals and rushed back into bonds. The US dollar surged. Yields stabilized. Inflation expectations dropped. It's twisted, but when gold bleeds, the dollar breathes easier. And central banks love that. The crash was a global reset button. It cooled the speculative fever, made currencies look stronger, and quieted inflation without raising interest rates further. Imagine trying to control a wildfire without using water, just letting part of the forest burn. That's what this was. Painful, controlled, necessary. But if that was the plan, who actually benefited? Not the average investor, obviously. Retail players lost faith. ETFs saw record outflows. Social media experts vanished. The winners were the ones with long-term positioning, those who knew how to read flows, not prices. They understood something most retail minds miss. Markets move on exhaustion, not enthusiasm. When everyone rushes in, you sell. When everyone rushes out, you accumulate. Simple to say, brutally hard to do. And here's where it gets personal. If you were watching gold prices last fall and felt frustrated, ask yourself, did you interpret the move or just react to it? Because every crash teaches the same ancient lesson. Wealth transfers quietly, from impatient to patient, from emotional to logical, from crowd to minority. And that quiet minority knew what was coming. They weren't chasing profit. They were waiting for real ownership. Because after every crash, physical gold and silver gets scarcer, not cheaper. Vaults empty, miners slow down, and supply chains tighten. This correction wasn't destruction, it was filtration. But of course, saying it's good doesn't make the pain go away. If you bought high, you probably felt betrayed. If you stepped back and watched, maybe you felt confused. Let's settle that feeling for a second. Because here's the paradox. The crash proved gold and silver are still real. A stock can go to zero. A crypto project can vanish. A currency can default. But when metals fall, they don't die, they compress, waiting for hands strong enough to hold them. And that compression always releases energy later. Always. You've probably noticed something interesting around now. Mainstream platforms suddenly stopped talking about gold. The hype faded. The spotlight moved to AI, to tech stocks, to something shinier. Perfect timing. That silence is the pro's signal. So let me ask you something. When the crowd stops watching, do you stop thinking or start preparing? I'd love to hear your take. Has this crash changed your confidence in precious metals or just your timeline? Comment your thoughts. Seriously, I read them. And if you want to keep catching these financial stories before they trend, you might want to stick around. Subscribe, not because it's habit, but because you like knowing how the game actually works. Now let's zoom out. If gold and silver's downfall was actually healthy, what does that say about our future? It means the monetary system still uses ancient metals as pressure valves. They rise when faith dies. They fall when faith returns. So the recent drop isn't proof of failure. It's proof that the global machine still knows how to breathe. But that breathing pattern is shortening. Crashes come faster. Recoveries strain harder. The time between inhale and exhale, between panic and relief, keeps shrinking, which tells us one thing. The next adjustment might not be about metals. It might be about money itself. Think about it. Physical gold has a limit. Digital money doesn't. Silver mining has costs. Money printing doesn't. So each crash in metals feels less like a market event and more like a quiet reminder of what's real and what's synthetic. The world moves toward infinite numbers, but still seeks safety in something finite. That contradiction can't hold forever. Someday, one side will have to yield. And when it does, gold and silver won't be villains or heroes. They'll simply be the only things still watching, silently, as the credits roll. So the question isn't why they crashed. The question is, what do we trust more, the price or the principle behind it? Love you guys. See you soon. Don't forget to like, share, subscribe.